Zoom out far enough, and savings stop looking personal at all. They look like a bet that society will remain boring, that contracts will be honored, that electricity stays on, that courts function, that markets open on Monday. Your savings don't need growth to survive. They need continuity. The real risk isn't a crash. It's a slow shift in norms. When people stop believing long-term promises are fair, savings lose their emotional anchor. Why save if the rules keep changing? Why wait if value erodes quietly? This mindset doesn't announce itself. It shows up as impatience, more speculation, more leverage, more risk-taking. Ironically, people chase returns because savings feel less safe, and that behavior feeds volatility. We've seen this cycle before. In countries where trust broke, savings fled first, not physically, digitally. Currencies weakened. Inflation accelerated. Confidence never fully returned. What's striking is how little corruption is required. You don't need villains, just math and time. Promises exceed capacity, adjustments follow. And again, it's strangers who decide when patience runs out. Foreign buyers refusing bonds, workers demanding more pay, investors reallocating quietly. Your savings are caught in those flows. This doesn't mean savings are pointless. It means they're misunderstood. Savings are not a shield. They're a position within a system that rewards stability and punishes panic but cannot survive without belief. The danger isn't that the system collapses tomorrow. The danger is that it changes slowly enough that people don't notice until after the adjustment is complete. History shows this again and again. People who saved responsibly still lost purchasing power. Not because they were wrong, but because the collective context shifted. And here's the hardest truth to accept. You can do everything right and still be exposed, because savings are cooperative by nature. They require participation from people with different incentives, cultures, and pressures. You're trusting strangers to behave rationally under stress. Sometimes they do, sometimes they don't. So, what protects your savings in the end? Not guarantees, not slogans, not even diversification alone. What protects them is whether society continues to believe tomorrow is worth cooperating for. That belief is fragile, but it's also powerful. Every paycheck accepted, every bill paid, every contract honored quietly reinforces it, which brings us back to where we started. That calm number on your screen. It's not just money. It's a reflection of social trust at scale. A web of strangers choosing, every day, not to break the system. The question isn't whether your savings are safe today. The real question is more unsettling. How confident are you that strangers you will never meet will keep believing in the same future you're saving for? Behind your bank sits the government, and behind the government sits debt, lots of it. Modern savings are indirectly backed by government bonds, the promise that the state will keep paying, taxing, borrowing, and functioning. Your bank holds government debt. Your pension fund holds government debt. Your insurance company holds government debt. It's the spine of the system. Now here's the twist. Governments don't store money either. They roll it forward. When a bond matures, it's usually paid by issuing new debt. When interest rises, that roll becomes heavier. This works only if strangers keep buying those bonds. Foreign investors, pension funds, insurance firms, central banks, people who don't care about you personally but care deeply about stability. Your savings depend on their confidence too. If they hesitate, governments borrow more expensively. Banks tighten lending. Economies slow. Nothing explodes, but pressure builds. And pressure changes behavior. Here's where it gets uncomfortable. Most savings systems assume tomorrow will look roughly like today. Not better, just familiar. But demographics are shifting. Populations are aging. Workers are fewer. Debts are larger. That means fewer people supporting more promises. Your savings are a claim on future productivity, and that future belongs to strangers. People younger than you. People in other countries, people you'll never meet. If they don't produce enough value, the system doesn't fail. It adjusts, quietly, through inflation. Lower real returns, currency weakness. Savings rarely get confiscated, they get diluted. That's the elegant cruelty of modern finance. Nobody knocks on your door. Your money just buys less each year, and most people blame themselves. Now add central banks to the picture. When systems wobble, central banks step in. They cut rates. They print money. They stabilize markets. This protects savings in the short term but changes incentives in the long term. More money chasing the same assets. Higher prices. Lower purchasing power. Again, nothing dramatic. Just erosion. And erosion depends on belief. As long as people believe inflation will stay temporary, they behave calmly. Once they stop believing, behavior changes. People spend faster, demand higher wages, avoid long-term savings. Trust unravels socially before it shows up statistically. This is why savings crises always surprise experts. The spreadsheets look fine until people don't, and technology has made this more fragile. Money moves at the speed of emotion now. A tweet can trigger withdrawals. A headline can shift bond markets. An app update can move billions in minutes. Strangers don't need to coordinate. Algorithms do it for them. So when people say, "My savings are safe," the bank is regulated. They're half right. Regulation manages risk. It doesn't eliminate dependency. Your savings rely on strangers continuing to trust a future they can't see. That trust is reinforced by habits. Going to work. Close your eyes for a second and imagine this. You open your banking app. Your balance is there. The number looks calm, solid, safe. Now here's the uncomfortable truth. That number only exists because millions of strangers you will never meet are quietly playing along. If they stop even briefly, your savings don't disappear in a dramatic crash. They just stop working. And that's the part no one explains. Because your money is not protected by walls, or vaults, or even governments in the way you think. It's protected by trust, distributed, invisible, fragile. This matters right now because the world is slowly relearning something it forgot during years of easy money and calm markets. Savings don't fail all at once. They fail socially first. Let me take you back to something simple. You deposit money in a bank. You believe it's stored, like a suitcase placed in a locker. But that's not what happens. The moment your salary hits your account, it leaves. The bank lends it, invests it, uses it as collateral, moves it through systems you'll never see. And that's not a scam. That's the design. Your savings are a promise, not an object. A promise that when you ask for your money, the system will still be functioning. Notice what that requires. It requires other people to not panic, other banks to stay solvent, other governments to keep paying their debts, other workers to keep showing up to jobs they don't love. Your financial safety depends on strangers behaving normally tomorrow. And most days, that's fine, until it isn't. Here's the quiet irony. The safer your country looks, the more invisible this dependency becomes. In stable times, trust feels like infrastructure. In unstable times, you realize it was just social agreement. Think about cash for a moment. Paper money is worthless by itself. It has value because everyone else agrees to accept it later. That agreement stretches across borders, industries, generations. You don't know the farmer who grows the food you'll buy next month. You don't know the engineer maintaining the payment rails. You don't know the bond trader buying your government's debt. But your savings depend on all of them. Now zoom in on banks. Banks don't keep everyone's money on hand. They can't. They never have. If everyone showed up tomorrow asking for cash, even the healthiest bank would fail. Not because it's corrupt, because it's mathematical. This system only works if most people don't need their money at the same time. Which brings us to the first uncomfortable realization. Your savings are safe only if other people don't need theirs urgently. That's not written in any brochure. We call this confidence, but it's closer to collective patience. And history shows how quickly that patience can snap. In 2008, people didn't wake up planning to collapse the global financial system. They just lost trust piece by piece. A bank fails. A rumor spreads. Withdrawals accelerate. Suddenly, savings accounts turn into exit doors.